is often gifted to loved ones. Investors and central banks seem to be falling head over heels for the yellow metal today. As we record this podcast on Valentine's Day 2025, let's explore this rekindled love for the illustrious metal. Today we have James Steele, Chief Precious Metals Analyst at HSBC, to help us navigate through the latest twists in gold's romance story. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this is the podcast for you. Before I begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and HSBC and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not recommendations, offers, or solicitation to buy or sell securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So welcome, James. Why don't you tell our audience a little bit about who you are, what you do, what does HSBC do? Give us a bit of an intro into your background.
Well, thank you, Nitesh, and thank you for the gracious invite from you and WisdomTree, and also to your viewers and listeners for taking up their time to listen to this. Well, I'm James Steele. No pun on the fact that I'm a precious metals analyst for HSBC of, I think, 19 years now. Before that, I worked for another brokerage house in New York, and before that, for The Economist magazine. I have covered a number of commodities in my time, but I've specialized in precious metals in the past 20 years specifically. And I'm charged with micro and macro analysis of the gold market and silver, as well as platinum and palladium. And we issue regular updates on the market, longer term outlooks, and price forecasts.
That's great, James. And so HSBC, I know you work in research, but I know it's one of the world's largest custodians for precious metals. I guess that gives you some quite unique insights into what's going on in the metal, where it's going, who's buying it. I don't know if you can tell us a little bit about some of the, the interesting insights that vantage point gives you.
Yes, indeed. It's rather a luxury being the precious metals analyst at HSBC because of the wide array of client bases that we have. We pioneered the first ETF, and we are the custodians for the majority of the world's precious metals ETFs. Our clients range from a short-term interest, various institutional clients, asset managers, hedge funds, trading right through to fabricators, refiners, central banks, and mining and recycling. So we're able to draw on a great well of information, and it allows me to have a perspective on the market that is not just related to paper activities, not just related to, say, what asset managers or hedge fund managers are doing in the City of London or in Manhattan, but right to how the physical market is reacting. Jewelry demand, coin and bar, mine supply especially, and recycling.
Wow, that must give you some amazing insights. So I guess our audience is lucky to be able to tap into your insights. And what a great week to be talking about gold. Gold hit a brand new high a few days ago on the 11th of February. Tell us, what were the drivers behind that fresh new high?
Well, I think, ever since I've been covering this market, and in one way or another, it's been about 40 years, as I'm sure, or getting on for 40 years. As you can tell, My hair was the color of gold when I first started covering these things, and now it's the color of platinum. But the same 12 or 15 factors that motivated the gold market and set the price in the 1980s when I first started looking at this market are the same 12 or 15 factors that set it now. Monetary policy, the US dollar, interest rates, inflation, coin and bar demand, jewelry demand, etc. The trick to analyzing and I think understanding this market is that these 12 or 15 factors are constantly in flux. Some of them are very important on one particular year, another time they're less important. And what we're seeing right now for the past couple of years is that geopolitics, after having been relegated sort of further down the ladder for a number of years, is now front and center. And without doubt, that's been the leader in this market. Now, this is dovetailed to more recent policy uncertainty, as we have not just the US, but we've had new governments around the world. We will have more elections. In addition, I think fiscal imbalances are increasing after also being relatively low on the influence scale are increasing. And these things, due to their unpredictability, have triggered a lot of safe haven buying into gold, which in turn has taken us to levels that I think have encouraged a lot of momentum traders and a lot of technically based traders to enter the market. It is, I mean, it's certainly very exciting and very dynamic right now. And I think this is going to be whether gold goes up or down. I think this is going to be the case for quite some time to come about the bullion markets.
And so I think you may have partly answered this question already, but we've seen bond yields spike up. Bond prices have fallen, and the dollar has appreciated quite substantially over the last couple of months. But over the past couple of years, really, we've been seeing the same trend. And for decades, we were seeing an inverted relationship between gold and bond yields and the dollar. That seems to have fallen apart over those last couple of years. How is gold defying those headwinds?
You're absolutely right about that. And I think this is that you've hit on the key thing of understanding the gold market in the last 2.5 years. Um, and if you anybody that looks on a chart will see this immediately. And the way we do it is we take the real yield on the 10-year and we invert it so that you see the positive relationship or you see the relationship with gold. Now, going all the way back to the early 1970s, when those economic historians in the audience will know that gold was decoupled from the US dollar, the final end of Bretton Woods, where gold was linked to the dollar, and the dollar was linked, and every other currency was linked to the US dollar, and the US dollar was linked to gold. Well, that ended, and gold became freely floating, as did currencies, by the way, including the dollar. Ever since then, we have had an inverse relationship between the real yield on, and especially on the 10-year. That was the one where the correlation was the closest. If you looked at the real yield on the 10-year from about 1973 right up until almost the end of 2022, you saw this beautiful inverse relationship. Same with the dollar. The more positive real yields became at any one time, the lower gold. Periods when real yields went negative, such as during the global financial crisis and during COVID, gold did especially well. That broke apart. That decoupled, as you very astutely pointed out, Nitesh, in about 2022, towards the sort of third, fourth quarter. Now, what happened, and it hasn't come back. Real yields remain positive, don't they? And the gold market continues to go up. Now, this was quite, for those of us that rely on empirical data, and it shows not to be a crude empiricist about how you employ these things for forecasting. This caused us to rethink the argument. And what we saw was a couple of things happening at the end of 2022, some of which still continue. First of all, the geopolitical risk dynamic rose. Secondly, inflation was clearly a problem. And further to that, central bank buying happened with a vengeance. Now, let me just take a second to explain about the inflation. When I first started covering the gold market, inflation would go up and gold would go down. And then inflation would go down and gold would go up. And I would think, wait a minute, this doesn't make any sense whatsoever. Until I realized that gold doesn't react to inflation. It reacts to the anticipated monetary response to inflation. So if inflation goes up, one thinks the ECB, the Fed, the Bank of England will raise rates, and therefore gold will go down. And the opposite. This explains why you sometimes get these counterintuitive moves in gold. This stopped in, and this was the attitude taken by the institution of people like your audience right now. This is typically how they would have analyzed and looked at the gold market. The retail side doesn't tend to look to the second derivative. Retail buyers tend to just simply look at the inflation levels. Sometimes they don't think about the anticipated monetary response. And that's what happened in late 2022. And we saw this through spectacular and unprecedented demand for bars and small bars and coins. And it completely overwhelmed this more logical relationship. The other thing, and that you take that along with the geopolitical risk thermometer rising, and you take the entrance of central banks in a bigger way. The previous 5 or 10 years, the average central bank purchases were 450 tons. And in 2022, it went up to near 1,100 tons, with more than half the buying in the last quarter of the year. So those things combined offset this relationship that heretofore had been absolutely reliable. Now, personally, I think we will go back to that relationship, but not as strictly as the history would have shown.
Wow, that is very interesting. Now, talking about central bank demand, the World Gold Council put out their data on gold demand trends last week. And they've reported the full year 2024 demand from all the sectors. One of the numbers that took me a little bit by surprise is the strength of central bank demand. And as you pointed out, central bank demand had been extraordinarily strong in 2022 and 2023 that we knew. It was more than double the prior 10-year average, as you said, over 1,000 tons. But if you look at the IMF, the International Monetary Fund, international financial statistics, IFS statistics, their numbers, which come out on a monthly basis, so we get higher sort of frequency on those, they would seem to be showing a bit of a slowdown in gold buying in the second half of 2024. But the Gold Council numbers looked very strong. I know the IMF numbers are only a partial window; they only maybe represent a quarter of all purchases anyway. But I don't know if you can help me square the circle there. I mean, who are the extra buyers, and where's that strength come from?
Well, I think you've partially answered it. Only about a third, I think, something like a third of the purchases reported by the World Gold Council are completely and utterly verifiable. That is to say, if one subtracts the IMF data, which is an absolute certainty from the World Gold Council, I think you get a majority that is quote unquote unreported. Now, those in the bullion market know fragmentally, that is, that there's been more purchases than the IMF data would have implied. But central banks are under no compulsion to name exactly how much they've bought when they bought it. Some central banks and you know and it's absolutely their right. There's no That's not a pejorative comment. We've gotten. I remember coming into the office one day many years ago. I think it was with my previous employment, and the Saudi National Bank had issued new numbers showing that they had made purchases for years previously. All of a sudden, they revalued. I believe it was them. I don't take me at gospel, but and we get that with other central banks too. So there's no set date when they don't have to name these things in a timely manner. But you know, the World Gold Council are in contact with many participants in the market, and they can glean from activities on the market, borrowing lease rates, discussions. They can come up with a pretty good idea of what happened, and I think that's the difference. Having said all that, I would agree with you. I think central bank demand is slowing from breakneck speed, but still well above historical averages. One does have to ask oneself, just to say quickly, you know, how much of the appetite will continue at $2,900 an ounce versus 2,300 when they were big buyers. I mean, they and central banks also, and forgive me for taking some time because it's a complex issue and it's important. Central banks also can play the long game, can't they? They're going to be around for many years, and they don't have to rush in and buy on any one year.
Yeah. And maybe the answer is given to us by the People's Bank of China, right? Last year, well, in 2023, there were crazy buyers. 2024, they slowed down. They stopped buying between May, but then resumed again in November and
Yes.
December. And they even made purchases in January 2025 with these astronomically high numbers. So they took a pause when some of the prices were actually slowing and restarted again when the prices were pretty high. Um, so you know,
You know,
do you think
I
the
think
PBOC will continue that?
well, I couldn't speak for the PBOC specifically, or any specific central bank that had not made a public comment. But I would draw the conclusion that in January, data was released showing that I believe the PBOC had a record trade surplus for 2024, and I think it was $1 trillion. Again, please don't take me as gospel, but it was record. Now, what does a trade surplus do? Well, a trade surplus means you've got a current account balance, which through the Bank for International Settlements and the international clearing system will mean, because the dollar is the world's reserve currency, whether you're running a current account surplus with the US or not, you will get an increase in US dollar reserves, won't you? In order to even it out. If I can remember my old international economics, trade balances and current account balances must add up to zero. And therefore, central banks that do run surpluses with the rest of the world, notably but not exclusively the US, will get more dollars. And this leads us to the point of, do they want as many dollars as they have? And this is not a de-dollarization argument, and I want to make that quite clear. I mean, we are of the view in HSBC that the US dollar will remain the world's reserve currency, certainly for years to come. But that's not to say that every central bank needs as many dollars as they have. But they may not also want to go into a specific other currency. Perhaps they don't want to go into the euro or the yen or something else. We know they're limited to what they can buy. So this might lead them a marvelous way of being out of the dollar, but without going into another currencies to buy gold. So this may counteract, and I think it does counteract high prices. It goes some way to offset. So does geopolitical risk.
So other bits of the Gold Council demand report showed there was quite some strength in over-the-counter demand for gold. Uh, what do you
Yeah.
think was driving that?
Well, here's where things sort of even out again, because we had, which we'll probably discuss a little later, I suspect, double-digit declines in jewelry.
Mm.
The over-the-counter market is this buying that is not coming in through, say, for example, ETFs, or not as rapidly in ETFs. They have stabilized and gone up a bit, but are nowhere near their highs. And this over-the-counter market, over-the-counter buyer is an example of hedge fund, asset managers, portfolio managers, a whole range of buyers. And I think they're reacting to the geopolitical risks. They're reacting to the threat of dislocation and the momentum buying that we're seeing in the market. And I think this is where a lot of this buying is materializing. Now, what I would say about precious metals in general, having also looked at in my career in commodities, petroleum, is the gold market is much more transparent than it used to be through the efforts of the LBMA. And we really have to give them a shout out. The London Bullion Market Association have helped make this market much more transparent, but it's still relatively opaque compared to, say, oil.
Mm.
And so this is where this buying is seen. We have a catch-all phrase almost, which is the over-the-counter market.
Okay.
It's hard to narrow it
I
down
think
more
you know
specifically than that.
yeah, yeah, it is tricky. I mean, but you've touched on the other components that I think probably help us work out that delta, and jewelry markets, right? We've gotten from one high price to the next high price, and as I said, the last high price was a couple of days ago. Um, there seems to be visible signs that this sector is hurting now. Do you think that will continue? Do you think jewelry
Yes.
demand will continue to fall?
I do, and here's how we look at it. About 70% of jewelry demand is in. I never use the term emerging world. There's nothing emerging about that part of the world. It's the non-OECD world. Um, about 70% of demand is in the non-OECD world, and 50% of jewelry demand is between China and India. Only 30% is Western Europe, North America, Japan, and Korea, by the way. Um, so jewelry demand is dictated by the non-OECD world, principally China and India. By the way, jewelry demand itself, not to keep repeating 50% all the time, but jewelry demand itself is 50% of all gold demand. So if you can figure out jewelry demand, you're halfway there. Um, and there's greater price sensitivity in the non-OECD world. And much of it's got to do with price transmission. Um, uh, Prices in London, Paris, New York, Tokyo, etc., are relatively inelastic. You don't see a great deal of change in the jewelry shops. When gold goes up $100, goes down $100. Because there's a margin there, and things are expensive for our jewelry operators. In Asia, by and large, in the non-OECD world, the margin is much more narrow, so that when you get a price change, it feeds through to the price in the shop almost immediately. Um, I've stood in a souk in Dubai, and I was buying a gold chain, and the fellow is plugged into Bloomberg or CNBC, and he's changing the price by $5 as we're chatting, up, down, because he can't afford to take a loss. So if you combine that with the fact that there's a lot more price sensitivity in the non-OECD world, then that's why we're seeing the declines in jewelry there. And it doesn't surprise me. And I think it will continue. I mean, jewelry is getting very expensive, even for more affluent buyers.
Mm. And I guess last year, the jewelry markets had the advantage in India, at least, that the import duties were slashed, right? So that spurred on a bit of extra demand. Probably won't get that again, right? What do you
That
think?
is
So,
correct. We got a decline from 15% to 6%, which was quite substantial. Um, and we got a jump in August. We also got a surprising jump in November, um, uh, maybe due to various wedding and religious holidays, but a bit lagged. Um, and I think these import levels will probably not be sustained going forward. And we did not see them in China. We continue to see very low demand. So the Chinese and the Indian market sort of decoupled there for a while. India could very well have been the world's largest importer and consumer last year by the time we finished looking at the data. Usually in the last few years, it's been China, but the two trade places.
yeah, I mean, I think we too touched on it earlier as well that exchange traded product demand for gold. That's kind of the market we Wisdom Tree operate in. It had been falling for two continuous years from 2022 to middle of 2024. Um, then it sort of plateaued. If we do start getting ETP demand come back in, do you think that would send gold notably higher, or do you think it's the OTC markets or others will pull back in that circumstance and level things off?
Well, this rally in the last few years has been the only rally that I've seen since the inception of the ETFs that's occurred without an increase in the ETFs. And it was another head scratcher because the ETF declines were occurring at the time that gold was going higher, at the time also that interest rates were going more positive. So in that sense, the ETF holders were acting very logically and rationally to the higher real yields. But the gold market continued to go higher. We fell from, that was natural, I think, when we got up to 111.5 million ounces, I believe, on aggregate in the middle of COVID or sort of towards the end of COVID in 2020. It was logical that there would be maybe some retracement after that, but we fell all the way to 80 million ounces at one point or near it, and now we're coming back up. We're looking for modest gains this year, and I think that will be supportive of the price. Some of this dislocation also occurred during COVID. That because of the big increase, there was this, as I say, this relaxation. But I would not. What I do think about the ETFs is that every 500,000 ounces that comes out of the ETF, the next 500,000 becomes harder to get out. You go from a point where you have, and I don't want to use the word hot money because but you get more flexible money at the top, and so they can move in and out. But there's a substantial number of holders of ETFs who have buy and hold mentality, be they insurance companies for portfolio diversification, asset managers, high net worth individuals. I mean, we've done work that's shown a lot of purchases of high net individuals is for inheritance purposes. So that gold isn't going anywhere, and that's why I think that even if the ETFs don't increase, by leaps and bounds, the downside's pretty firm. We're getting to levels that's going to be pretty stubborn for it to get much lower.
Yeah. Now, I guess one market that defies that trend of ETF outflows or plateauing is China, right? ETP demand in China was at record highs last year, um, and I guess it's maybe due to lack of alternatives in things to invest in. Do you think that will continue in China, or do you think that there's a change in the mix going forward?
I suspect it will, and I think you've put the other investors. We're speaking out of New York and London right now, right? Where investors in Europe and North America have a smorgasbord of choices, right? Um, uh, I think they should look at gold, but they don't have to look exclusively at gold. Um, and those investment choices in other parts of the world are more narrow. So when you get, especially in China, when you get property and equity weakness, um, a big favor is for investors what becomes favored, I should say, is bullion. And what bullion has shown over the past few years is its ability to weather all sorts of different climates. And I think that as this is that are more widely known, it will keep the demand for these instruments at a good level in China. And this is all part of the democratization of gold. And the marvelous thing about gold, it's an incredibly democratic investment, and we saw that when the ETFs first started in Western markets, and the same appeal is now being translated to other markets as the ETFs as an instrument, mature.
Wow. Now, staying on China, I read that Chinese insurance companies now can invest in gold. I think maybe to a limit of 1%. Do you, do you think that'll be a big game changer in terms of new demand for gold out of the country?
Well, right now, to my knowledge, it's a pilot scheme um, for the top 10. Now, I'm sure the top 10, I haven't looked at it specifically, but I can imagine the top 10 insurance companies in China have considerable assets. And 1% might sound like a small amount, but I think 1% of anything in China is considerable. Um, and, and I do think, yes, and I don't think it would necessarily push us higher, but this is yet another reason why I don't think that a major retracement, like to say below $2,000, and I'm just taking that because it's a round number, is likely. We're just getting more of this interest in bullion, which I think is not necessarily going to send us hundreds and hundreds of dollars higher, but will certainly put a floor on the market.
Now, you mentioned in your in sort of intro that it's geopolitical risks that were been driving gold prices higher over the last couple of years. Um, but is geopolitical risk really rising or is it falling? Because we've got now a ceasefire in the Middle East, maybe fragile, um, and there's now discussion of peace talks in Russia, Ukraine. They seem to be maybe dialing down a little bit. I know I acknowledge it completely fragile. Is there other things going on? And I think you touched on it as well in terms of policy uncertainty. Maybe you could just unravel that a little bit more. How are how are the, three, four things really pushing and pulling against each other?
Well, I agree, but I would just make a note that it was the IMF or the World Bank. I can't swear to which. last year said that the number of geopolitical incidents or events in the previous couple of years were double the level of the previous 15. Now, unfortunately, it's like the evening news. Geopolitical events have to be bad to get the press. We don't talk too much about positive geopolitical events, do we? Usually, when you hear the word geopolitical, it's, oh my goodness, what's happened? Um, Now, things like the end of the Cold War, the collapse of the Berlin Wall, the reunification of Germany, those were all positive geopolitical events. But we've seen precious few of positive events of that nature. So I would say that the geopolitical thermometer is still pretty high. And I don't know how tenuous or long lasting the events in the ceasefires in the Middle East may be. I'm certainly not a geopolitical expert and wouldn't pontificate on that, but they still look pretty high. Also, the thought of the idea of a ceasefire and end to Ukraine conflict is very new. It's just hit the market very recently, so we'll have to see how that develops, and we'll also have to see if the market believes that a settlement in Ukraine or the Middle East is going to be long lasting. If it's a stopgap, if it's a temporary fix, or if the market perceives it to be a temporary fix, then we'll still get support for gold. Now, I'm not saying it is or it isn't. And I don't want any of your viewers or listeners to think that James Steele from HSBC is making any determination about these things. But moving strictly off of geopolitics, but keeping it on political uncertainty. We have a new administration in the U.S. We have a relatively new one in the UK. We're going to have elections in Germany. We have a lot of uncertainty. We're not quite clear on what a lot of the policies are going to be going forward, for good or for bad. And again, I'm not making a comment about this, but we've seen a lot of initiatives recently, and we'll just have to see how these things play out. But if you don't know, which is the case with almost all of us, then gold is what you should, I'm not saying is what you should turn to. Gold is one of the things that one would turn to. And I think that's what we're seeing. If we get clarity over many, many issues, then perhaps we would get a cessation in this level of gold buying. But we don't seem to have much clarity at the moment, be it trade or be it the budgets or whatever.
Yeah. And I guess on that topic of trade, while it's a source of gold price strength, the uncertainty around trade is a source of gold price strength. The uncertainty also has injected a sense of disruption into the gold market as well. And what's happened is the spot markets in London, Zurich, seem to have been slightly decoupled from the futures markets in New York in COMEX. Can you help our audience just unravel that? And I know it's a complex thing. We could do an entire podcast just on that one topic, but just very quick, high level. What's going on there, and why did that disruption occur?
Sure. And just to keep it sort of simple, because it is complicated, but just to distill it down, if tariffs, there's normal flow of gold. London is the center for physical gold, and New York has the COMEX in it, the CME, where I used to work, by the way, down on the floor. For any of those who've ever seen trading places, I was one of the people down there. I wasn't trading. I was standing looking at them reporting back to the office. And and there is a normal uh, uh, arbitrage between the futures price and the spot price, which is set in London. And by buying one, selling the other, you might be able to make a small amount of money, and it's very modest. Like all arbitrage, right? It's narrow. The windows of opportunity are narrow. They don't last long. The possibility, and I stress possibility, that tariffs would be put on bullion coming out of London to headed for New York in order to make the relationship between spot and COMEX work, um, would necessarily blow the EFP out. And if you, what we're seeing is not just from London, but also from other parts of the world, gold moving to New York in order to be prepared, even if it's not COMEX deliverable. Sort of, the difference between 100 ounce bars, 400 ounce bars, you would still tend to send it into New York, to safeguard yourself. Now, whether tariffs will be put on gold or not, or so, same is happening in silver. We don't know, but it doesn't necessarily impact the overall price, and I think that's important. It's the shift of gold from one place to another. The gold market, like other commodities markets, is a swimming pool. A bucket in and a bucket out, no matter where you put it in the swimming pool, raises or lowers the pool by the same level.
Mhm. So
But you're right, Nitesh, there's been a
I
lot
know,
written in the press about it.
yeah, yeah, and it's getting a lot of attention. And one of the things that's getting some attention is, as that gold moves away from Europe, London, and Switzerland, to New York, does that hurt the liquidity in in London? I mean, has liquidity been damaged as a result?
Well, there's a lot of gold in London, and I don't think yet. No, I don't think so. Uh, we also saw similar things during COVID, and that was because we were concerned about, or the market was concerned about, refineries shutting down because of illness, and also chartering airplanes. Air traffic was disrupted with COVID, with pilots, and also tests. It interrupted the free flow of people around the world, didn't it? Um, I remember not being sure if I was going to get out of Heathrow back to New York because I wasn't feeling well that day. Fortunately, it wasn't COVID. I just wasn't feeling well. Um, but this just had a big disruption, and we had the stocks build up in New York, and then over time they went back to London.
Hmm. Yeah, that's the key thing. Over time they came back to London. Do you think if um, gold and other bullion gets a specific exemption from tariffs, universal tariffs, do you think that gold will start to flow back again, or do you think it could stay in New York because you never know what happens next?
Well, certainly if the EFP starts to come down, it would necessitate, I think, some of it at least moving back to London. And there's a whole logistics behind this. It doesn't happen overnight. And silver is even more cumbersome.
Speaking of silver, and I know our podcast is mainly geared towards gold, but you are, a precious metals analyst. So let's give a few minutes to silver at least. Um, you know, can it catch up with gold? It's been doing well in certain fits and starts, but today, certainly this morning, we saw a nice catch-up rally. Will that catch-up rally continue, do you think?
For much of my career, and I suspect a good portion of yours, Nitesh, the gold silver ratio traded between 50 and 70. Um, and for anybody who is not quite familiar with that term, the gold-silver ratio is simply how many ounces of silver does it take to buy 1 ounce of gold. The range over the past 50 odd years has been 35 to 100. It hit 35 when gold was at $850 an ounce in 1980, and silver hit nearly $50 an ounce. It went to 100 when gold fell to $350 an ounce, and poor old silver dropped to $3.50 an ounce. Now, there's no fundamental reason why there should be a relationship between the two. But there is. There is because investors say it so. There are similarities between gold and silver, obviously. But this ratio itself is not set in stone. Now, we went yesterday over 90, which is historically very, very high. And I think part of the rally, just today may be some catch up in that respect. Now, I do think that silver is less. Look at what's been driving gold: geopolitics, policy uncertainty, trade issues, the possibility, and we didn't mention it, but a decline in world trade is always positive for gold, and increases in trade are usually almost always negative. Silver is less sensitive to those things. So it would be expected, I think, that in an era that when gold is being pushed by these issues, that silver would lag gold, to the point where investors recognize or believe that that silver is undervalued, and then silver catches up. It's a thinner market, so you don't need anywhere near as much attention on silver to really push it higher or to sell it off on the downside. But it's very interesting because I think we have silver in a sort of golden age where it's being influenced more by gold than it is by some of the underlying fundamentals, which are good, but not necessarily highly bullish.
But I guess beyond the gold correlation, we've got pretty strong demand for silver right now, right? Especially in industrial demand. Is that all a photovoltaics solar panel story, or is the demand growth broader than that?
Well, we do have good industrial demand. Absolutely, it's been going up quite notably. And what is interesting, I mean, I think your listeners will probably be saying to themselves, "Well, hold on. Industrial production over the last few years has been modest at best, and it's taken a backseat in China, the major industrial power of the world. So why would Nitesh and James be saying that industrial demand for silver is so good? Well, because the best application, the most intense applications for silver happen to be in those parts of manufacturing that are increasing the quickest. Electronics and solar power are doing better by and large, and other things that consume silver are doing better mostly than the underlying industrial production globally. So we're seeing outsized demand for silver. And I think that's likely to continue. Now, even there, however, we've seen a little bit of moderation, haven't we? There's not going to be as many generous subsidies and things like that, not just in the US, but across other countries. So some moderation, but I agree, it's outpacing industrial production, and it will likely be higher this year, and it was higher last year. But I also should add, coin demand is not good. Bar demand, so-so, and jewelry demand also is down. So these things, now they're not as important for silver as they are for gold. They're not as big a percentage of demand. Industrial demand is more than 50%, like 56, 58, depending upon the year. But but we have negatives, we have a drags on that level. And just on the supply side, we have a pretty good mine supply. A lot of it coming from non-silver mines, non-primary silver mines. Uh, tin, lead, zinc, gold, nickel, etc., copper, and also scrap recycling. Above $30, it's pretty attractive to recycle some old silver. You could have bought it at 10, 15, $20. So the supply is going up.
Now, turning back to our earlier discussion on gold and central banks, central banks hold a lot of gold. Not many central banks hold silver. I think the uh, Russia's central bank talked about putting silver in its reserves. Do you think other official institutions could go head that way? And it's not necessarily central banks, but maybe other, strategic reserves. The reserves held for military defense uses or just stockpiling for future energy, um,
Yeah.
you know, energy
Um,
technology uses.
in the case of central banks, I think not. I do not think any central bank, though I could be wrong about any particular one, um, but I don't think it would be universally adopted. Uh, they have they have gold, and I think that's where they'll stick. Um, it's possible. I do not know myself, but it's possible that sovereign wealth funds, which is often, misses the audience that a central bank does, but we should note that many countries in the world have sovereign wealth funds, and they take profits from oil or from other um, or from other commodities that they export, and they use that, to make investments. It's possible that silver could be utilized there. Um, now, and forgive me, the second half of that question, Nitesh?
Yeah, it's just whether central banks or these other institutions like defense or, as you mentioned,
Oh,
several
yes,
sovereign wealth
yes,
funds.
yes. Things like the
Yeah,
defense,
you
yes,
yeah.
excuse me, I'm sorry. Things like the
Mm.
Defense Logistics Agency, which ran down metals. I don't think silver's scarce enough to be that attractive. I think if one was to start to stockpile again strategic minerals, it would be other metals that would be chosen. Silver, the British Geological Survey, they used to have a marvelous survey which ranked the availability of all metals in the world. And copper was the most available, and the rare earths were the least available. And they had a scale, a number of factors they would ask questions, and I don't think silver was that high on that. It's in a lot of countries, in a lot of storage.
So, James, could you share with us your average forecast for gold and silver this year?
Yes, for gold we have $2,687 per ounce, and for silver we have $30.28 per ounce. But I should give some background to that. We are looking for a very wide range in both those metals, and for the strength to be in the first half of the year. And for as certain issues, maybe reduced policy uncertainty, more clarification on trade, things like that, to calm the market somewhat, but for them to remain nonetheless at historically high levels.
Thank you so much, James, for sharing your valuable insights with us. Please do let our audience know how they can read more of your material and follow you.
Thank you. I'm quoted, I think, in the press. For those of you who are HSBC clients, you can receive the material by signing up for our research.
Great, well, thanks everyone for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more from us at Wisdom Tree, please do subscribe to whichever platform you're using. You can follow me on X, formerly Twitter, with the handle at Nitesh Shah WT. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a range of research materials and insights. Until next time, goodbye.